Hello everyone, and welcome to episode 2 of my Monopoly series. In this video, I'll be going over monopolistic companies, as I think they're a great way to learn about different companies that are dominant in their industry or have very few competitors. This can lead to finding high-quality companies to invest in the stock market. If you haven't seen episode 1 of my series, I highly recommend it, as it covers the Hershey Company, which is actually a wonderful business, and the stock price has been in decline, so please do give that a watch. Before we begin, let's define what a monopoly is. A monopoly is a company that sells a product or service with little to no competition. They can control pricing and create barriers to new entrants in their industry. In this episode, I'll be covering the Monster Beverage Corporation, the energy drink monopoly. This company was founded in 1935 by Huber Hansen in Southern California and was known as the Hansen Natural Corporation. They actually just produced juice and soda products. In 2002, they introduced the Monster brand energy drink, which we're all familiar with today. By the year 2012, the energy drink division became the largest source of revenue for the company, and shareholders voted to change the name of the company from Hansen's Natural to Monster Beverage. In 2015, Coca-Cola took ownership of the company's juice and soda brands, and then Exchange gave Monster their energy drink brands, so they basically just swapped properties. The Coca-Cola company bought a 16.7% stake in Monster Energy for $2.15 billion. Their ownership stake has increased to 19.3% due to share buybacks Monster did over the years. Coca-Cola's stake is now worth $11.28 billion, which is an over 500% return in just 8 years. So now let's prove that Monster Energy is an energy drink monopoly. In the United States, you can see that Red Bull is the market leader. However, it is a privately traded company and we can't invest in it, which is why we're looking at Monster. Monster Energy is far and away the number 2 energy drink brand. Bang is the next, which is actually owned by Monster as one of their sub-brands. Rockstar is next, which is owned by PepsiCo. Reign is also owned by Monster, so they own 3 out of 5 top leading brands of energy drinks in the United States. As of 2020, they own 39% of global energy drink sales, which means more than 1 out of 3 energy drinks sold worldwide are owned by the Monster Beverage Company. The beverage industry is absolutely brutal, and the large companies make it nearly impossible to get any shelf space in a store. The bear case for the company is that consumers will want healthier options for high caffeine drinks, but the company has already introduced many low-calorie and low-sugar options to combat this issue and ongoing health trend. Now, before I go into the financials and finally a stock valuation on what price I think the stock would be a good entry point, please consider leaving a like and subscribing to the channel if you enjoy the video. So Monster Beverage Corporation trades under ticker MNST on the NASDAQ. So the stock price is $52.95, but as I've stated in episode 1, that tells us absolutely nothing about the value of a company. We need to be looking here at the market cap. So the market cap is $55.47 billion. And is that a good price? Well, we'll find out. But first, before investing in any company, let's look at the financials and just see how they perform over a longer period of time to establish a history. So we can see back in 2015, they earned $2.7 billion in revenue. And we can see that each and every year since then, they've had, pretty steady, predictable growth. A really good year in 2021, like twice as good as normal, and then back to normalized levels. So it seems like they can grow their top line at about, 10% on average, with a couple of, good outliers recently. So maybe there's been an uptick in energy drink consumption in the past few years. And we can also see that their gross profit continues to grow over time. That demonstrates good pricing power if the margins are not compressing over time, because that means that you cannot raise the prices of your product without affecting your sales. We can also see that the company has a very strong balance sheet. So total assets come out to $8.2 billion, and their total liabilities of all their debts is $1.26. So in total, there is about $7 billion worth of equity, and it seems like the cash flow statement is pretty nice to see as well, with nearly $1 billion or slightly over that every single year in free cash flow. Their capital expenditures, aside from the past 2 years, have remained, reasonable. So they have a nice bottom line profit. They also don't pay a dividend, so that's not taking away any of their free cash flow, as the business still seems to be able to reinvest into itself for a decent rate of return, and they seem to be rewarding shareholders through share buybacks. That can be a good or bad thing. It just depends on the valuation of the company and whether the company believes that the shares outstanding are undervalued, maybe their fair value. Perhaps they feel that they get a better return purchasing back their own stock versus reinvesting it back into the business. Let's take a look at what a good price to pay for Monster Energy would be. So now, using a discounted cash flow method, let's try to determine what the fair price of Monster Beverage is. So the revenue growth by analysts expected over the next 5 years is going to be 23%. So let's put that in. They earn about 20% of their free cash flow as a percentage of their overall revenue, and we're going to give a terminal multiple, so just the valuation at the end of the 5-year period. I'll say it's going to be at 25 times free cash flow for a business that can grow at over double digits. I don't think that that's too silly, especially when Monster has been so consistent for a long period of time. And for the desired rate of return, I'm going to go at 13%, just because if I want a 10% return, I could just buy an index fund like the S&P 500 and not take on the additional risk of owning a stock of an individual company. So I need to be rewarded for taking that risk. So that gives me a buy target of about $57 if I want a 13% rate of return. Now, I do think that 23% revenue growth for the next 5 years is kind of tough to predict, especially when Monster has not historically grown at that revenue rate, at that growth rate for most of its history. Maybe earlier on, but again, Monster's a more mature company. How much more growth is there in the company? So let's have a bearish assumption as well. So let's just assume the analysts are totally wrong. Revenue growth goes down to 11%, their historical average. The free cash flow percent as a percentage of revenue, I'll keep that the same at 20%. Their margins have been very steady, so I see no reason to beat them up there. And I'll go with the same 5-year period, just because I think if you go too far off into the future, the discounted cash flow valuation method just becomes very inaccurate. It's very difficult to predict long periods of time. I think it's a lot easier to predict 5, because generally, if the company is pretty stable and consistent, you can predict the next 2 to 3 years pretty well. And then, adding 2 years onto that, you're far more accurate with your math and your assumptions. So we're going to say that it's going to be valued at 20 price to free cash flow going out 5 years from now, which gives us a buy target of $29.44. And if we combine those two totals together, it gives me a buy price of $43.28. So with that math, it seems that Monster Beverage is about 20% overvalued if you want a 13% rate of return. Now, if you think that the company will do better or match the analyst expectations, you could lower your desired rate of return and the stock could become a buy. But I'm going to stick to my method of trying to outperform the market overall, just because of that additional risk of having all of your money into one company versus having it over 500 companies. There's a lot more that can go wrong. It's a lot more unpredictable. So definitely, if there's more risk in investment, give yourself a larger margin of safety. If you're more confident in the investment, then you can take a smaller one. If you're really confident in the company and the quality is really up there. That being said, the valuation does seem a little bit high right now, but I definitely think with all of Monster Beverage's qualities, it's definitely one to keep onto a watch list. They have a high return on invested capital in the near 28% or so. So pretty high. That's, almost like a tech company nearly, and it's, just a beverage company. So pretty good stuff there. It has a strong balance sheet, a good history of solid top and bottom line growth. And never buy a stock just because I'm buying it or any other YouTuber or any random person on the street tells you to buy a stock. Always do your own research and make sure you understand what you're getting into before investing any of your money. All right, have a great day, everybody, and good luck investing out there.